Let's see if I share. Okay, can everyone see? That's okay. Thumbs up. Oh, yeah, except I jumped way the hell ahead. All right, back it way up. So very good. Thanks very much. I'm very pleased. It's a great pleasure. Some of my favorite folks are here in the Zoom room, as well as several. If you'd asked me to name like my top 10 people that I would like to look at this paper and give me comments, a bunch of them are here too. So that's it's really great. And thanks, Tony, for organizing. So I want to start with just sort of a broad fact that some of you may know. I did not know this, and apparently everyone in the finance industry knows this, but to us it was a little bit surprising. So we cut this off at 2000, but like even if you go back, you can trust me that if you go back to the 90s, okay, and you split every year, this is really simple. I'm just saying every year, split all stocks, listed common stocks in the United States into terciles in terms of their AMIHUD, and then tell me the average, or I think it may be the median AMIHUD in each of those three terciles, okay? And throughout the 90s, you have to trust me on that, but through the first half of the zeros, okay, they're just on this like parallel, all three are just parallel, like liquidity was improving for all, pre-existing classes of liquidity. In all areas of liquidity in the market, of the stock market, liquidity was just this parallel trend that is getting better and better and better. Now there's aggregate trends that like liquidity gets worse when the market, dumps and improves when the market rises, that sort of thing. But they all sort of track basically really nicely in parallel. Okay, and then about like 2005, it's really here clear for the AMIHUD measure. You can see that this is a log scale, right? So since, let's say, 2005, for the medium liquid stocks and the most liquid stocks, you can see that the AMIHUD, the price impact, has shrunk by like 60%, and pretty much the exact same. We've continued on this really nice parallel trend for the medium liquid stocks. The least liquid tercile of stocks, the average AMIHUD or the median AMIHUD, I forget which this is, but same for both, has actually gotten wider. There's more price impact. They are less liquid than they were 15 years ago. Okay, and much the same with effective spreads. You can see that they're on this really beautiful, clear, perfectly parallel track up to about 2005, and then since 2005, the other two improve. The top two classes of liquidity improve, and roughly speaking, if I want to cherry pick 2005, again, literally there's basically no change in the effective spread for the least liquid tercile of stocks. Now, of course, everyone's, you can quibble, that there's different, I'm sorting on the outcome measure here, and there's like different stocks that are entering and exiting. So I'm comparing apples to oranges over time. If you put it in terms of first differences, and you keep the same year over year, and you plot it that way, the same conclusion emerges. The graph kind of looks like a plate of hurl, though, and it's not so nice. Here it's like very clear, but you can trust me that if we do it carefully, you see the same effect. So since 2005, the liquidity of the most liquid and medium liquid category of stocks has continued to improve, but there's this weird detaching of the least liquid stocks in the sample. Okay, now what has happened? What else has happened over that period of time? Well, here's AUM into US equity ETFs. I don't want to talk so much about AUM though, because we want to get away from this idea that you're going to look at ETF holdings. We don't think that ETF holdings are what you should really look at or care about when you care about asset markets. You should really care about ETF arbitrage activity. That is to say, these are the dollars separated of creation and redemption activity, creation of new ETF shares by authorized participants, and redemption for the underlying baskets by authorized participants stacked up, I think, quarterly, and you can see there's like a very clear, widening that plausibly was kind of a rounding error prior to 2005, but now accounts for like this huge chunk of aggregate trading activity, right? And so we're going to present some theory and evidence that these two trends are kind of related to each other. Okay, now why is that? Okay, let's situate very briefly in the literature as a whole. There's a Greenwood's paper, and there's this well-known paper by Z and Sophie that shows that more ETF, is it membership in an index, I think, right, that's traded by ETFs and index funds results in like a higher correlation with the rest of the index. So that's, you know, an effect on asset markets. There's this famous / infamous Ben David paper that shows that more ETF holdings are correlated with volatility, and the Charles Lee and co-authors paper that have some things about some associations for price efficiency. And there's this related paper with Russ Wormers that they find that an increase in ETF ownership, and again, I want to argue that's not what we care about, is on a quarterly basis, there's kind of this association with improved liquidity overall. Okay, so that's just to sort of set the stage. That's state of the art, I think. There are fewer papers, I think, that really approach the data and the effect on ETFs, of ETF trading on the underlying asset markets with a sort of a mechanism and a model in mind. And that's one of the things that we hope we're bringing over and above the Wormers paper. So we're not looking at levels, we're looking at a relative effect, and we're coming in with a model, with a mechanism, okay? And Sean's paper with David and Matt, obviously they have a nice mechanism to disentangle, like they argue you can disentangle fundamental and non-fundamental shocks in the underlying markets, which I think is really, you know, clever and a great paper. And the Penn and Zhang paper argues that if the ETF providers, if they have like a separate actively traded or proprietarily trading portfolio, that might tilt how they trade and how they determine their basket for the ETF itself. Okay, and so we're closely related to that, but we're asking a completely separate question, which does not rely on, you know, cross holdings or those sorts of things. And so the main insight that got us started, you know, and the main mechanism that I really want to say is, I don't think we're the newest, but I don't think we're the only ones to do this, but this is the idea that motivates the paper, is that almost every model of passive investing that I've seen, some of my colleagues have models of, you know, there's a bunch of proliferation of models of, you know, the rise of ETFs and index investing in general. And they commonly make the assumption that, oh, well, the ETF or the passive fund is just going to replicate, or like in a CAPM world, they just replicate like the market portfolio. And you go, oh, okay, right, that's okay, that's a model, right? But is that really a realistic assumption? So if I take, if I handed, you know, Raleigh $1 billion right now and said, Raleigh, replicate the Russell 3000 for me right now, right? Raleigh, you know, Raleigh is not immediately going to go out and buy like the Russell 3000 perfectly pro rata, right? He's, you know, I'm saying Raleigh's smarter than that. He would, you know, immediately do a bunch of, you know, he would tailor his trading strategy in some way. And that's the simple, I mean, it's so obvious that, you know, it's kind of like this model almost has to be true, I claim, right? I mean, we're economists, right? So we think, yes, okay, this model has to be true in some sense. And so when I came across, you know, doing all my background reading, as I now do about ETFs all day long, I came across this like Fidelity white paper where they said, this figure is not ours, to be clear. This is from some Fidelity white paper where they're like, an optimally sampled, you know, underlying basket keeps both the tracking error and the trading costs low. And look, there's a trade-off, and you pick the point at which the marginal, you know, costs and benefits cross. Is kind of amazing, right? So this like made me laugh because I came across this after we made our model of exactly this. Okay, so let me just explain the model. It's like really, really, you know, straightforward and simple. So this will take like 2 seconds. So there's N assets in the market. They're not all necessarily in the index. They have a vector of prices. There's a 1-period model. Okay, I'm going to assume that there's no difference in R and the expected returns, and the covariance matrix is just what it is. Think about like daily returns, because one of the things that we want to really focus on here is that the daily returns are kind of, you know, we can tie them very tightly to the daily creation and redemption activity in the ETF. Okay, so over a daily horizon, hopefully you're okay with me setting the R is the expected return for all assets to 0, okay, or normalizing, let's say. And so there's this index that's exogenously given, okay, by some provider, and it's you know, a vector of weights on the assets that adds up to 1. So Will decides to go into business as an ETF provider, and all he does to do that is he publishes a basket, which is a different vector vector of weights, potentially W, and they also have to add to 1. And Will agrees to create or redeem shares of his ETF in exchange for that basket of assets, right? And he has some costs in so doing, but there is free entry into being an ETF provider. So in equilibrium, his fees equal his costs. And so that's not very interesting. And of course, his daily NAV is then just going to be W prime times P. All right. There's one or more authorized participants in this market, okay? And those are, large broker dealers that Will designates and says, okay, those 3 broker dealers or whatever have access to my create redeem, mechanism. Those APs may, but are not required to, make a market for the ETF. And so, let's suppose that Tony is one of the APs. So he looks at the underlying, asset markets, and he says, okay, when I get hit or lifted, I'm going to sell or equivalently buy the underlying asset. And at the end of the day, I'm going to close out my net position via the create redeem mechanism. Okay. So there's this cost of trading in the underlying assets, which ends up being, related to the basket that Will defines, obviously. And here's the expected profit from posting this offer for Tony. And posting the bid NAV minus B is just, the reverse of that. Okay. And it's just B minus the expected cost of trading in the underlying assets. So as long as there's at least 2 APs, they compete in a Bertrand fashion. So as long as you have 2 or more APs, there's no market power and you get to the perfectly competitive equilibrium, which means that the bid-ask spread of the ETF is always exactly the NAV plus or minus the expected cost of trading the underlying assets. So it's just pinned down by the trading costs that are in the basket that Will publishes. Okay. So this is like very, very, very simple, right? Like the simplest possible model you could have of an ETF market. And so Will, the ETF provider, says, okay, my objective is to minimize the expected bid-ask spread and to, at the same time, minimize the tracking error on my fund, because that's what investors care about, those 2 things, okay? And they like a tighter bid-ask spread and they like less tracking error. And it's exactly, looks like this, okay? So that's the whole model so far, okay? So out of that, we get, a very classical, like first-year finance PhD course, first-year asset pricing kind of predictions about the basket weight W that Will chooses relative to the index weight V that actually is the thing he's trying to track, okay? And we thought previously, about 48 hours ago, I thought that it was decreasing in the trading costs. That's sort of obvious. I thought it was increasing in the correlation with the index and ambiguous in the asset volatility. However, Sean has already astutely pointed out that prediction number 2 is not quite accurate. It is in fact a little bit more ambiguous how the weight should change depending on the asset's correlation with the index. But so we're going to say ambiguous, and prediction 1 is the main sort of prediction we're going to hang our hats on. Now, unfortunately, we sort of have only the stale and pretty noisy data on fund holdings. On ETF holdings, it's like quarterly, right? But we can still at least say, okay, if I put a dummy variable for if the asset was in the index, but the fund did not hold it, okay, how does that correlate with the other aspects that the asset has to do with it? It's more likely to be omitted, strongly more likely across a bunch of different fixed effects type things. If the bid-ask spread, the effective spread, it looks the same with the AMI-hood if the AMI-hood is higher, right? So this part is probably not that interesting. You're like saying, yeah, this is all like pretty obvious. It sort of has to be true. Fair enough. Okay, so next, this is the more interesting part, maybe. So next we model trading behavior. Now again, we're on a, think about a daily time frame, right? Because again, we're the create, redeem, and the liquidity data we're going to use is like daily data. Okay, so on a daily basis, we're going to say it's just all noise traders. They're all trading for exogenous reasons. There's no particular predictability that's going to, or if there is predictability, that's not going to like bias our results in a first order way. Okay. Initially, the noise traders are just trading the individual like assets in the index. Then Will comes in, introduces the ETF. They're allowed, but they're not required to use it. It's just, one more option for them to trade in. And in the model, there's two effects that appear. There's a netting effect, which is kind of nice, right? Which is that if 20 of us were previously wanting to exposure to this index, and we were kind of homemade indexing in the sense of trading, a bunch of the underlying assets, previously we each would bear that cost because each of us has to transact. But Will, on the other hand, can take 20 of us that buy and 20 of us that sell and net that out. Or let's say 22 of us that bought and 20 of us that sold, and net that out. And he only has to incur the costs when he nets out the net +2 position at the end of the day, right? So the netting effect suggests that ETFs just provide this nice place for investors to meet and trade at a much lower effective cost in the end. And we see that in the ETF, the tremendous liquidity and the tremendous appeal of ETFs to trade. Okay, and then second of all, well, more on the appeal side, there's this demand effect where we say some investors initially wanted to trade this particular index, like the tech sector dividend, stars or whatever, but they didn't, actually trade because they said, oh, my all-in costs of like self-indexing and trading all those individual assets myself is too high. But now there's this highly liquid, one-shot ETF that's offering that exposure, so they trade it. So more investors crowd in and more will trade. And the effect on asset liquidity of the underlying index assets is depends on the netting and the demand effect. Okay. The main prediction that comes out of the model is that the introduction of the ETF causes a Matthew effect on the liquidity of these underlying assets. Because through the basket that Will publishes, which is biased, as we said, towards the more liquid assets and tends to underweight or omit the less liquid index assets, all this noise trading activity gets channeled towards the more liquid and out of the less liquid assets, which further exacerbates the differences in the pre-existing differences in liquidity. So greater ETF arbitrage activity, primary flows, should produce a relative drop in turnover in the least liquid assets and a relative decrease in liquidity in the liquid assets. So it's always nice to see a graph, right? So here is the relationship between ETF primary flow on that day. This is daily data for like the last about 10 years, I think, right? For the most liquid stocks, that most liquid tercile, this is quintile actually, the most liquid quintile of stocks measured as of the previous month. So I'm not quite regressing outcomes on, and this is the change in the effective spread. So I claim I'm carefully like whitening things out and I'm not regressing Y on some function of Y, okay, I hope. And so you can see there's really no relationship for the most liquid stocks out there, quintile of stocks, okay. For medium liquid stocks, there's a little bit of a relationship. Those are 95% CIs on the coefficient, okay. There's a bit of a relationship in both directions, right? That for days when there were a lot of redeems and days when there were a lot of creations, right? There's a positive reflect that the effective spread in the medium liquid stocks got wider. And then here it is for the quintile of least liquid stocks. You see there's a really strong relationship in both directions, right? That days with lots of redemption activity and days with lots of creation activity in the ETF, the quintile of the least liquid stocks, least liquid ex ante, their liquidity got much worse in both directions. Here that is in table form. It looks pretty much as you'd expect. Columns 3 and 4 are looking in either direction. The key thing to see is that the relative effects of the least liquid versus the most liquid, right? And we have day fixed effects, and we have a bunch of other like fixed effects and stuff. Is sort of pointing in the direction that the model predicts. Okay, regardless of the units in both directions, there's a relative decrease in turnover and a relative worsening of liquidity for the ex ante least liquid stocks in the index. Okay, now endogeneity, right? There's lots of omitted variables, lots of things going on. We've really just shown you an association here, right? There could be, like, for example, on days when there's a lot of market moving news and price discovery happens mostly through ETFs, right? So the ETFs have a ton of trading activity. Thank you, Tony. And, they're churning like a ton, right? There could also be this relative effect that market makers say, oh, I'm facing a lot of really bad adverse selection today, so I'm going to widen my spreads, especially wide in the illiquid stocks, right? That makes a lot of sense. If we control for market returns, and also if we simply drop all days where the market moved appreciably, okay, we end up with the same results, in fact, even stronger. When we directly control for other things that have been shown to affect stock liquidity, the results, are the same or even stronger. So it doesn't seem to be driven by, the market's movement or the arrival of, new information, new news. At least we, fingers crossed. Okay. Now, again, that's sort of indirect hand wavy evidence. A unique prediction of the model, right, is, here's another fun fact for you, is that some ETFs say in their prospectus, we replicate the index by strategically sampling a subset of index assets. Other ETFs, and this is sort of a puzzle that we're still trying to understand, frankly, say we are fully replicating, and we replicate, our holdings will replicate pro rata, more or less in real time, everything that's in our target index. And you'd be kind of shocked, I defy anyone ex ante to tell me which of these tickers, which of these ETFs is a fully replicating one. I mean, I've told you here, but if I just said to you, VTI or IVV or IVW, right? These different ones, which ones are fully replicating and which ones are samplers, so-called, which in Bloomberg shows up as flag optimized, you probably couldn't tell me offhand. I don't think most investors, you might have a prior, but you probably couldn't tell me offhand, right? Now, you'll notice, of course, right off the bat, that the full replicators tend to replicate more liquid and large cap indexes, right? And the replicators tend to be a bit smaller, and they tend to replicate more small cap or total market or less liquid indexes, which again makes some sense. They're following there, et cetera. So we construct a matched set of sampler replicator ETFs that follow the same 4 character crisp objective code and have similar AUM as of the start of the year. Okay. Here's just to convince you that overall we do, the sampler and replicator, the matched set, those funds look pretty similar ex ante. They look really similar on AUM. And I told you that each pair has the same exact, tight objective code. So they follow a similar index. The samplers have slightly lower fees and slightly lower turnover. Maybe not that shocking, right? Because they're sampling and not fully replicating. Now here is the same result split when I just regress on the primary flow in replicators. And you can see the results are on effective spreads are actually flipped around. They point the opposite direction to our model, okay? And they're much smaller. Basically all of the results in the aggregate seem to be driven by these sampling funds, okay? Which is again consistent with the story. Okay. The overall point is that we predict this may not be the most interesting prediction or consequence of the model. This is still a very early stage project, okay? But the basic point is that the model, at this point, the most interesting prediction we think is that ETF primary flow amplifies pre-existing liquidity differences in the liquidity of the underlying index assets, and that as investors pile into the ETF, noise trading activity gets channeled out of illiquid assets and into liquid assets, and liquidity follows. Now, currently, these results don't really speak to, I think Sean in particular pointed out, can we say something about the overall effect on investor welfare or liquidity? Who gets hurt, who gets helped? Our sense is, and we think we can hopefully show some results in the next draft that will speak to this, that investors simply must be better off, right? Because everyone in this model is rational, and there's no entry costs or market power like anywhere in this simple model. So if you give investors another venue in which to trade that's, has certain advantages, to the extent that they use it, they have to be just better off, right? So overall, investors have to be better off, we think, and get better execution with the ETF than without. But that's connecting those dots will take some more work. So that's it. Thanks very much.